Samir Arora, fund manager with Helios Capital. He joins us live from Singapore. Samir, good morning. Thank you for joining us. Samir, we're off to a good start for the year 2013. What's in store for us for the rest of the year after a good, start?
Well, first I should say Happy New Year to you and all the viewers. And I think it's not just a phrase. I think this will be a Happy New Year 2013, because it is clear that all the problems that we were facing in 2011 and some parts of 12, a major part of that could be attributed to the government of India. And no longer can we say that. The government has shown outstanding initiative in resolving issues and trying to resolve issues. Not that everything can be resolved just by decisions of the government. But in general, one of the biggest negatives that we had for the not in the second part of 2012, but prior to that, a major part of that, we can see that the government is doing whatever it can. And also the rest of the world seems to have stabilized, although the US fiscal cliff problem was only averted but not really solved. But in general, in a positive environment for equities anyway, where you may have seen recently that there was record flow into US equity funds for the first time. I think one day soon our Indian investors will also wake up. But even if they don't, the markets are going up on foreign flows and the fact that there are real changes on the underlying decision making and policy making, which are very crucial in our context for our markets and for our economy.
So Samir, the way triggers are stacked up, do you think we are on course to touch a new high and then stay above that very soon?
Well, new high in rupees is relatively easy to achieve. We have to achieve a new high in dollars for the foreigners to be happy. But in general, the market should be up, because if you look at why did we lose in dollar terms, okay, let's forget about dollar terms. In rupee terms, the market lost some 25% in 2011. It was not so much to do with the fact that we had bad earnings or that the earnings disappointed. It was to do with the fact that a major part of our market was affected by slow decision making and lack of decision making and controversies. And then the finance minister came out with a budget which on fine print turned out to be one of the worst budgets in terms of not respecting foreign investors or any investor. And those things are getting reversed. So the last year's rally, although very, very good and very welcome, still does not even, take into account what we lost in 2011. So considering that, forget about comparing it to 2007 end. From 2010 end also, all the things that were negative, many of them are hopefully getting reversed, and now we may have an interest rate cycle reversal. Therefore, to reach an all-time high in rupees is nothing. We should reach much more than that.
The big story indeed is TCS. Do you think 2013 will be a better year for IT stocks, and on a YTD basis after the recent run-up, IT stocks could still give a positive return?
I think they could, because one reason is that last year they clearly underperformed, and part of it was to do with the fact that Infosys was sort of standing out, and therefore even if you were bullish on the other companies, you felt that how can it be that Infosys is doing so badly in the same environment. Actually, we ourselves are actually right now underweight tech, or we were underweight and we still are. And so in some sense, we also one day, but not right now, will maybe have to reluctantly add a little bit more. But in general, because the US corporate sector is very strong and the US financials companies are quite strong. If you just look at their stock performance, these financials were up as much as 100%. Bank of America was up, and Citi was up some 60%, and generally the whole industry. And so therefore, from a big picture sense, there's a catching up to do for the sector when you look at last year. And because Infosys has definitely sort of put a floor on its own share price, I think the IT sector will do well. Now, whether it does better than all the other sectors, I don't know, but in general, it will be satisfactory performance at least.
Samir, what explains the rally that we are seeing currently in the real estate pack?
Well, for the first time, even we own a few real estate stocks for the last about 30-40 days. But in general, these are all big picture things. I can tell you why we bought it. Maybe we bought it in mid-December or early December. Is the fact that last year in 2012 January, there was such a high beta rally, and we normally don't like those stocks. We normally buy our own old favorites in the sectors that you already know many times about. But we felt that we needed to buy some optionality in case there's a big sector shift. Now, in terms of explaining it from a bottom-up basis is actually more difficult, but you could say that the real estate sector has done badly, although last year they did quite well, but in general they've done badly compared to their highs, that the real estate underlying value prices have gone up all these years, and that they will be in a big picture sense because they are leveraged, they'll be beneficiaries on a top-down basis of any improvement in liquidity and reduction of interest rates and things like that. It is very much a top-down call, so we have quite little of them, but we have some 4-5% in these stocks, which we, over 3 names, which we call buying optionality through stocks rather than having very strong views in any one of them separately.
Now, Samir, I can think of at least 25-30 real estate stocks. So which are the 3 out of those 25-30 stocks you own?
Well, the thing is that, we have learned from our other examples that we should not talk about individual names so easily because people then remember only those names and not what happened to the whole portfolio. So forget about it. It's basically obvious names, but not something which needs so much research. All of them have done well anyway, even the ones we didn't own and the ones we own. But the thing is, what I'm saying is it's more of a top-down thing that normally there are even though I am myself not a top-down investor beyond a point, but the fact is we know that how many models work, how many top-down systems work, which is there's an interest rate decline, there is this decline, and they search certain standard pattern of stocks. They will look for state-owned banks, they will look for real estate, and then they will look for high beta, they will look for high leverage. And those guys who are now driving our market, all these guys who come from abroad without any underlying analysis in at least 30-50% of the cases, and they're quite large in terms of their impact on markets, we can, up to a point with some bottom-up analysis saying that, okay, we believe that this company at least has some potential of benefiting from this and is otherwise half strong, we can also play it for small periods of time and with smaller positions. So they're not worthy of my labeling any one of them as some great pick of mine, but it's just to cover the fact that in certain environments, the sector shift and the shift to high beta and the shift to leverage and the shift to slightly lower quality does move quite meaningfully for us to say that we will not touch it at all. So that's what we have done.
Samira, Arshia, international kind of names as well, part of the list that are best forgotten?
Correct. See, that's what I mean. I believed in it. I believe in it. Right now, it is no longer anything to do with fundamentals. It has to do now with the leverage of the promoter. And therefore, there's nothing we can do. So we have it and we will continue to have it for the moment till we know how this is resolved. But that is what I mean by saying that maybe some other fund managers are right when they don't talk about any stock. I have all my life from 1993 told the world what I own, what I like. It worked most of the time. That is why, I still get money from investors. But any one name does bring these problems, which for our portfolio, okay, it has already hurt a little bit at the beginning of this year, but because it's a portfolio approach and it was a mid-cap stock, so it was not our top name among the larger names, therefore its impact is there, but some other stock will go up hopefully and make up at least X% of it. But to tell an individual name to an investor who then thinks that that is one name and he should buy everything in that name alone, that is the problem which I never appreciated till now in some sense, because I would therefore always come and tell you names. Now maybe the other guys are right, but they look at it the other way. I think the mutual fund industry in India, why it is not able to raise money is because it has gone on the other end and become extremely, extremely boring in terms of presenting to an audience the returns that can be made from a market. Just to give you one specific example, I think 3-4 days ago there was a cover story on how Government of India should sell Sutti shares. And one CI of a private sector fund said all the right things, that government should sell them. It will give a strong signal to the markets that we are interested in solving our fiscal deficit, and this is a much better way than doing some other things. But then he said, please keep my name anonymous. So if a guy in this market is not even able to talk about perfectly reasonable thing with a perfectly reasonable analysis, but he doesn't want his name to be public because it is so controversial, as if it is so controversial. Here I am on the other end telling you stocks, so I also have to learn from all these guys and maybe just give you big picture things, but that would make me boring. And maybe after some time I will be able to resist not being so boring. But right now I'm trying to be boring now.
Well, if I insist that you should not be boring because that is not your style, and if I insist that we should talk stocks, why don't we talk stocks?
So let me overcome this recent debacle in some sense, and we'll come back, no problem.
Private banks, you've liked that space. We know that. You own HDFC Bank, you own IndusInd Bank. Any reason to believe that these stocks could underperform now, because the run-up in last 2 or 3 years in some of the private banks you own has been quite extraordinary?
Well, we own even more. We own Yes Bank, we own ING, we own all of them. The thing is that we, in our portfolio, why we don't get blown up, and now in our hedge fund we have to be even more careful than before, is that you don't want the highest possible return in every stock in your portfolio. So we have basically 2 categories of stocks. One is high confidence in reasonable return. That means it should do well, it should not pain you if the market falls, it should not fall apart, it should not lead into scandals, and generally you feel that it will do well and compound well. And some 60-70% of our portfolio will be in that category. The other is so this was high confidence in reasonable return, and the other is reasonable confidence in high return. Sometimes that confidence does not yield fruit in some sense, like you may say currently in Arshia. But in general, we find that we have had many multi-baggers. None of them you could have said high confidence in high return. Nowadays, I see so much conversation on all these stocks saying we should not buy leverage stocks, we should not buy reverse listing stocks, we should not buy stocks in infra. None of them would have worked, because there are hundreds of examples in each category where the best stocks that later on turned out to be so obvious initially had these problems. I read somewhere somebody said we should not buy reverse listing. Well, currently the McDonald's North and West, I think, or whatever that franchise is basically got reverse listed. If it was available tomorrow, I would buy it. So the thing is, there are no rules, but therefore in these reasonable confidence in high returns, because the confidence can at best be defined as only reasonable, even if you actually may feel that this is a real multi-bagger, but it will have some problem on that first day when you buy it, to not get super confident about it, and therefore you should have maybe 2%, 2.5% if best in any of these names. Right. And then hope that some of them work and some of them will invariably not work. But they should not embarrass you like this one seems to have embarrassed me right now. But let's see how it develops.
Okay, final question, Arshia. I promise this is the last question. At the current juncture, do you think Arshia could be a high risk, high return idea? Because according to you, the business model or the business thesis is still intact. The stock has fallen not because the business model is faulty. The stock has fallen because of leverage problems.
No. It has fallen because infra is obviously having problem and a new sector is creating problems, and therefore in some sense aiming for high growth led to higher debt and higher capex and plans which could easily have been delayed. So it's not that it is not having business problems. Obviously they didn't pay salary, so it is having business problem which we didn't know or appreciate before. It is just that it has got exaggerated with this. So now I have no comment on this, because I myself don't know how this will be resolved. If it is not resolved well and it just goes up 10, 20 bucks, even I may get rid of it saying that there is an additional business problem. Although in a longer term sense, it's like any of these infra companies, that they all have serious, in some sense, a need, and the implementation in this case has been good. But it could take 3 years instead of 1 year, because it's such a new sector that maybe every rule has to be made for them, and therefore it will benefit somebody else later on. We don't know, so I cannot comment, because I myself don't want to be tied in that I said something to you and 1 week later I do something different. But right now, anyway, there is no opportunity for us to do anything other than look at it going down. But at this price, we don't know. Just forget about it. Move on.
Okay.
Samir, what about Bharti Infratel? Are you still staying put with it?
No, we don't have it, and we have no plans of having it. And we don't like the whole idea of having 3 customers, all business, all insider. I mean, insider means related party, and to feel that is some business that India needs. Because, in abroad, you may need these businesses because you feel that you are working for a high dividend or a high sort of, stable earnings. In India, we don't want all that. We want a little bit of growth and a little bit of more attractive thing than just saying that we are making a high earnings yield or dividend yield, because in India interest rate is 9%. We don't need all these things for via stock market.
Fair point. That's an excellent point, that if you park money in a government bond, tax-free return is about 9%. Samir, now the story for 2011 and 2012 was dividend and diversification. Markets were clearly hiding in stocks which offered strong return on equity and predictable earnings. Do you think that trade is now looking slightly mature and money will start moving out of the classic pharma and FMCG and consumer names?
Well, that is why I was saying that in December we also felt that we don't want to overstay our welcome, and therefore we bought. Now, instead of buying or having faith in any of these companies to such an extent that to say that, because all those companies is the tough thing, that when in bad times those companies really look bad and not worthy of your investment. So instead of trying to find two companies where you normally take 3-4% stake, we said let's buy optionality by buying some beaten up names across sectors where cumulatively we may still have only 10-15%, but it is not in 2 names or 3 names, it may be in 7 or 8 names. And the idea, and so far real estate has worked. So it is only with that fear, but not getting carried away, that we have in a sense bought this real estate and another 2 beaten up names in other sectors. But so far we had not bought any infra, pure infra as you call it, but they were in some sense beaten up in different sectors. The idea being that maybe the world will broaden its investment horizon and its investment scope. We don't want that to happen beyond a point, because we don't have enough of those stocks, and we will never have enough of those stocks, because at the end of the day we don't take, if we take a top-down view or these kind of views, they are not aggressive per se. So we don't want this, but that risk is there, or that opportunity is there, whichever way you look at it. But from a retail investor point of view, my thinking is that these guys who are watching your program, some of them may have because they trade a lot or whatever, but generally there is, in a big picture sense, very little equity exposure. So at the first level, there is no need to steer them towards high risk, high return stocks, or stocks which have lower quality, because invariably they will be disappointed in one name and that is the only name they would have bought and things like that.
Fair point.
So I would still think that HDFC banks and IndusInd banks will do adequate job. They may not give you the biggest bang for the buck, but this is more of an introduction to many of our Indian retail guys who've forgotten that they have an equity market in India.
Yeah, test your waters with something safe and more predictable rather than going all in when it comes to risk. Samir, final question. I've got a minute before I lose the link. Last time you had mentioned that you are bullish, and you are bullish on media, and the digitization opportunity could be a game-changing move for the sector. Media stocks in the last 3 months, they have seen a decent amount of run-up. Are you still hot on that space?
Yes, I'm very hot on that space, and we bought even one more media stock. So now we have literally every stock. You guys are not listed, so we don't have your stock.